welcome the Managing Director of AB Bernstein, Richard Clarke, and Skift Senior Research Analyst, Seth Borko.
Good afternoon. Seth's going to come and join me in a minute to do this debate. For those of you who don't know me, I'm Richard Clarke. I'm the imposter here. I don't work in the travel industry. I work in the finance industry. But I do cover the travel industry from there. So if you don't know AB Bernstein, we're a sell-side research house based out of New York, as you can probably tell. I'm British. So we write research reports about the travel sector, or I write research reports about the travel sector to advise institutional investors what they should or should not buy. So I mainly cover the kind of blue chip companies. But AB Bernstein's a bit different. It's not one of the big bulge bracket banks. We have no investment bank, so we're fully independent. And we like to think we take a bit more of a sort of long-term fundamental industry view rather than just sort of focusing on the next quarter's earnings. So I'm just going to talk today about a few things that I've found interesting, try and take a bit more of a kind of financial view at this. I'm going to talk about where are we in the recovery, both from a sort of share price perspective and from a fundamental perspective. I'm going to talk a little bit about OTAs versus hotels, which comes from really those first slides that we'll have. I'm going to talk about inflation, which is the most common conversation I have with my clients these days. And then just to finish off, I'm just going to present what may or may not be the real blue sky scenario when it comes to travel. So just to start with share prices, having said that we don't focus too much on the day-to-day movements, I thought I would start on here. So this is the change in enterprise value because some of these companies have raised debt, some of them have raised equity over that time, so this sort of smooths that out. And it sort of shows the different things. It's interesting, the very first session today, I think Dennis said, is Expedia seen to have fallen behind? Well, not its share price. Comfortably the best performer in my coverage, at 81% since the beginning of January 2020. And actually, even though we're certainly not fully recovered, you'll notice that most of these stocks are above the x-axis. Most of them are in positive territory. But there's two trends that I think I would pick out of this. One is US has done better than Europe. So Expedia's done better than Booking. Hyatt and Hilton have done better than Accor, American Airlines better than IAG. But also, the online travel agents have performed better than the hotels on a regionally adjusted basis. Expedia above Hilton, Hyatt, Booking above Accor by a fair margin. How reasonable is that? So if we start with geography, and if some of this text is a bit small, find me afterwards, I'll send you the slides. So certainly where we were in Q4, which is the last time we got any kind of report from these companies, Middle East was the place to be, was in positive territory in the fourth quarter of 2019 for most of the companies. But the Americas were doing better than Europe. So it does make some sense that we saw that transition. That's where it's been better. Now, data, I think, through the last couple of months has seen Europe begin to catch up. February was actually the best month for hotel revenues since the pandemic began. So it has begun that sort of catch-up process. But it is still behind where the US is. Just a little aside on what about the effect of Omicron. This is some commentary we've got from the online travel agents, and we can see that December was really the low point in recent monthly data in terms of bookings, in terms of demand. And it was beginning really to kind of pick up through January and February. In February, although it was a record month for hotel revenues, in terms of demand, it did fall off a little bit, certainly into early March, as a result of the Russia invasion of Ukraine. But even that's begun to pick up again. So we are seeing, these temporary effects, the effect of some of these factors, external factors, are fairly temporary, and we are, in general, on that recovery process. But what about hotels versus the online travel agents, versus Booking, Expedia? And this is a chart I don't think anyone else has done, which is simply looking at the number of room nights that these companies sold in Q4 2021 versus Q4 2019. And I think what's very telling here is that the hotel groups, Hilton, Choice we've got there, Hyatt, sold a higher percentage of their 2019 level of room nights than Booking and Expedia did. Accor in the middle there, but that's obviously partly to do with its big European and Asian focus. But even that hasn't lagged Booking. Now, there are lots of explanations here. The hotel groups have added more hotels. Maybe the online travel agents haven't signed up more hotels through the pandemic. But probably if we were having this debate 2 years ago in the midst of the pandemic, we would have thought leisure recovery would massively favor the online travel agents. It hasn't happened. We've seen the hotel groups recover at least as well as those online travel agents. Now, what about going forward? I said that one of the reasons that the hotel groups have done better is because they've grown share. They've added more hotels to their platform, whereas I say the online travel agents have not added more hotels to their platform. But that opportunity is ongoing. That is not just an opportunity today. And in particular, something you'll hear the hotel executives talk about is the increase in conversion. And here in London, the Westbury, which is about 10 minutes walk away, very famous 5-star hotel, great restaurants, that's joining the Marriott portfolio next year. The Dona Filipa hotel I used to go to a lot as in my privileged childhood in Portugal, is now joining the IHG connection. And there remains a great opportunity for these independent hotels. We think there are about 63,000 independent hotels of more than 75 rooms that could join these branded networks. Now, what you might say is, but the OTAs can sell something else. Hilton only sells hotels, Hyatt only sells hotels, Booking and Expedia can sell other bits and pieces. They can sell flights, experiences. We've heard a lot about those today. What we believe is that hotels is, as far as a distribution perspective, is the best opportunity in travel. I won't go through every last detail here, but probably the top right-hand chart is the most important thing. If you work out the potential commission pool that online travel agents can go after, hotels is much bigger than private rentals. It's much bigger than airlines because it's a big industry. It's 80% of the lodging industry. But it's also a high commission market. Hotels will pay 15, 20, 25% commission. So you have a big profit pool available to them that isn't available in the other parts of the market. Now, what about the competition with private rentals? If we went back to the earlier chart, we would have seen that Airbnb has recovered ahead of most of the hotel groups. So certainly private rentals are breaking some of that transition. But actually, if we look pre-pandemic, we know that private rentals are having their moment in the sun through the pandemic. That's undisputable. But if I look pre-pandemic, the years from 2015 to 2019, actually, if we look at the total lodging market, the private rentals gained about 3.2% market share. The top 10 hotel brands globally, so includes all the Chinese brands and the big Western brands, actually grew market share by 4.5%. If we look at the major cities, these are 9 of Airbnb's top 10 cities, supply of branded hotel stock grew ahead of private rental stock in 6 of those 9 cities. So you're not seeing, certainly on an urban basis or a total basis, this shift from brands to private rentals. Probably what you are seeing is maybe some of the independents being squeezed between the two. Now, just to talk about Google, I mean, is Google the friend or the foe of the online travel agents? We've had a few questions about that today. One of the things we've been tracking is obviously some of the changes that Google's done. Last year, Google allowed organic search results on their Google Hotel platform. They've now this year, just in the last couple of weeks, adding even more visibility and putting them on Google Maps as well. So they're getting more visible. But we're looking here at the transition last year. And what we saw as Google allowed organic search results is it refragmented the market. Suddenly, lots of online travel agents that we hadn't heard of came into the market. And in June 2020, your average Google auction had 6 companies competing. Probably most of those were Booking and Expedia own brands, plus 1 or 2 others. By June 2021, that was up to 14.5. You know, a huge increase in the number of companies taking part in that auction. And what about the direct option, the ability to book direct? Well, that went up 3-fold. So the number of those auctions that we looked at where there was an option to go and book direct went from 21% to 69% in the US. Now, there might be a pandemic effect here, obviously June 2020, right in the depths of the pandemic. So maybe there's some effect there, but still a big increase. These organic search listings are making a difference. And they're also making a difference in terms of price. We did a recent pricing survey where we looked at where are you most likely to find the cheapest price. So maybe some consumer side here. And Google came out on top. You are likely to find the cheapest price. It's a limited sample, admittedly at 335 hotels, but Google was likely to find you the cheapest price 50% of the time. And I think consumers ultimately will go in that direction. Now, who is offering that cheapest price? Which is the outlet on Google that is giving you the cheapest price? If you look at the bottom chart, it's the direct option. Now, we're doing 22% of 50%. I don't think, obviously that's down to a smallish number, but that is where you're seeing that differentiation. And when we talk about online travel agents versus the hotel sector, Google is a good partner, I would say, for getting some visibility of that direct option. Now, just on one slide about inflation, I probably could have done 50 slides about inflation, but the debate I have with my clients about inflation swings from one side to another. I would say there are those that are very, very bullish about inflation. They would say, Hilton don't operate the hotels, Booking don't operate the hotels, Expedia don't operate the hotels. So if the hotel puts the price up, that means that those companies are going to make more money, but not have to incur any of the higher costs of inflation. So it's good news. And then there are those that say it's bad news because high inflation will restrict usership of hotels, less new ones will be opened. Now, I'll start on the bottom left-hand chart here, which I think is interesting. There's very little correlation historically between inflation and industry pricing. It doesn't seem like inflation has driven pricing. So the fact that we're in an inflationary environment now and prices are going up doesn't match the historical pattern. They haven't been linked. The top chart says historically pricing was linked to demand, which makes sense, economics 101, but even that relationship has broken in about the last 7 or 8 years, that you've seen occupancy go up and pricing have done. Now, what is pricing dictated by? Probably is a topic that we could go on to a long time, but it doesn't seem to be inflation, it doesn't seem to be demand, so I don't think we can be too optimistic that just because we've got high inflation in the system, that hotel pricing is going to be perpetually going up. Now, if you wanted escape from it, the bottom chart shows where you do get pricing power is the luxury end of the segment. That's where you really do see prices go up in high demand and high inflation environments. So if you want protection, that's the place to go. And this is a chart that just shows, actually interestingly, way before COVID, even before we had inflation, I would say that the hotel groups were skewing themselves to the areas where they were de-risking themselves from inflation. Luxury, we talked about that, that's got the pricing power. Limited service, extended stay, that's where you've got low labor intensity, and so your high margin hotel products, so therefore you're less at risk. And what's really shrunk, if we look at Marriott, is they're not building many non-luxury full service hotels at all anymore, because that's where inflation was happening. That was happening pre-COVID. So these, in many ways, a lot of the hotel groups were ahead of the trend, sort of appreciating this, de-risking themselves over the years pre this inflation bubble. Now, just to finish, maybe something slightly lighter, I sort of traced the history of holiday allowances in the UK. I can't go through all of this, but back in pre-1829, the average British person had 40 feast days. Now, they didn't have Saturdays off then, so it wasn't the great life you think it was. But by 1834, beginning of Industrial Revolution, they'd lost a lot of that. And then from the 1870s, it started to build up again, trade unions, etc. We got added on a lot of paid holidays. Paid holidays started in 1938 in the UK. And as of 1998, the average person in Britain gets 28 paid days off. Now, what would that person sitting in 1871 who started that mission of, I would like to, we're going to campaign for more paid holidays, think that we aren't taking it. Now, actually, here in the UK, we're pretty good. We take 25 on average of our 26 days holiday, but there are a lot of countries which are not taking their holidays. Japan, United States, Australia, Italy, I was quite surprised by, India, New Zealand. Now, this, for me, is probably the blue sky scenario. Does COVID and the flexibility that we've heard a lot of speakers talk about today, the mobility that this gives you, mean that you're going to go and take your holiday? And if you take the US here, that's 40% growth in leisure travel just from everyone taking taking all of their holidays. That, I think, is probably the blue sky scenario, is that's what could change with COVID. That's my last slide. I'll invite Seth on, and maybe we can debate some of those points.
Yeah. All right. Hello, everybody. That was wonderful, Richard. I love numbers. Let's debrief it a little bit. I'd like to talk about it a bit. I think one of the things worth talking about that we were kind of dancing around with inflation, with those things is, things seem to be going, right now where we are relatively up in the cycle. It seems like we're in a recovery. We were maybe due for a recession in 2019. Like, are we just going to return to where we were in the cycle in 2019 and kind of, how cyclical is travel going to be?
Yeah, normally the answer to that question is very cyclical,
Yeah.
And it's interesting, I think, as we approach the summer, which everyone's looking out for. I've done some work that shows that summer holidays actually aren't that cyclical. What's very cyclical is the second holiday. So that's when leisure travel gets hit hardest, is actually in the winter, autumn, springtime. But in general, overall demand is quite cyclical. My view is, and we didn't talk about too much in there, but the recovery tidal wave will sweep over any of the ripples around sort of short-term cyclicality. But we do get that question, where should we be worried about it? And normally, you'd think luxury is not the place to be. It normally is the most cyclical end of the market. I think we're in an environment, actually, an odd scenario, where I think we can be quite bullish about luxury.
It's interesting because the ADRs, I feel like in 2019, our ADRs were kind of reaching pretty near like cycle peaks. Now in some markets we're back above 2019 ADRs. It feels like maybe it's getting stretched a little thin. Does that tie into the inflation conversation?
Yeah, I mean, I think there's some oddities with pricing at the moment. I mean, flexible rates, I think 90% of people are booking flexible rates.
Yeah.
That actually pre-COVID was about 60, but it's still a big increase. Flexible rates can be 12, 15% more expensive. So that's providing some tailwind to rates. You've also got you've still got uneven demand, and you're still going to have uneven demand this year. And what we've seen is Florida is going to be mad busy again.
Yeah.
New York, probably still a little bit lighter. Some markets are still going to be a bit below. But what you're seeing is that price integrity in the low demand markets and a lot of pricing power in the high demand markets. Now, as demand re-evens out, which I don't think will be this year, but next year, you might lose some of that pricing power. So I don't want to be too optimistic about that the industry suddenly found pricing power from its back pocket somewhere.
And I like that. So let's talk about inflation a bit, good or bad. I think it's kind of a good thing for the industry. I think it'll help. You kind of had a different conclusion there. Like, you think it's going to chip away at margins, or?
I think when I think about my hotel groups, probably the big risk is construction.
Okay.
The biggest, we've been in odd times, but if we went pre-COVID, because actually pricing power wasn't that great, the biggest driver of growth at a Hilton or Hyatt is new hotels being built. Now, we've talked about conversions, and that will help to some extent, but where you can see some risk is if construction prices go up, you're going to have a little bit less construction. So that's where it might hurt. And then also, some of these companies get incentive fees, so they have some ties to inflation in that respect. But, if we get enough pricing power to offset it, maybe it can be good. I think you'll have pricing power this year. I'm not so certain it will carry on into next year.
Yeah, and I like that slide you had, price and power versus demand. But I couldn't, you showed that nice gap, which I liked. I couldn't help but think that maybe it's a supply mismatch. Like, I know one of the things that luxury's been struggling with is they typically have more rooms, and maybe they don't have a whole wing that's closed, whereas on the economy side, they have usually smaller properties. It's easier to get those occupancies up.
I think the other factor that we would want to add in there is the alternative products. And what I mean that is the Airbnb, the alternative accommodation. What's true is, and lots of people in this room will know this better than I do, but some hotels in the world make most of their profits on a few nights a year, the compression nights. Those compression nights have dropped. Pre-COVID, they were dropping. Why? Because suddenly there's an alternative product. That's inflation 101. If there's an alternative product, you don't get pricing power because you can just go to something else.
So that's conflicting a little bit because, I'm not conflicting, but that's like maybe the pricing power is not all the game it's going to be, kind of to that, like maybe we won't get to offset all of that inflation.
We'll have to see what happens to the private rental supply. I think the Airbnb speaker said that they've seen an increase in active listings. I think that's skewed away from cities and towards rural locations. I think in cities, actually, some of their supply's gone down. If that stays down, so there's less alternative product, maybe we will get more pricing power.
Well, if construction is going to be expensive, you can always look to conversions. That's a big opportunity that you talked about. I think independents have done pretty well during this crisis, though. Is that your sense as well, or no?
I think independents tend to skew more rural, and they tend to skew more leisure, of course. So they've probably been in a bit more the sort of sweet spot. But I think what you find is coming out of this is they do have some challenges. How do you operate in a post-COVID world? And this isn't going to be true of every independent, but I think you can just look at the examples. Would the Westbury, very famous London hotel, have decided it wanted to join the Marriott portfolio in 2019? Maybe not. Coming out of this, fluctuations in demand, having to go after different types of customers going forward, that's maybe making their decision. So some of the examples point to the fact there is demand for that branded product out there.
Yeah, and of course, less competition, less pressure from Booking.com if you're branded, right? You have a little more pricing power on your commissions.
Yeah, they prefer the industry to stay fragmented.
So then does more conversions spell bad news for the OTAs in your view?
Ultimately, yes. I think if you fast forward 10 years, it's fairly glacial. But if you fast forward 10 years and you think about what does the hotel industry look like, my view is the hotel brands will have another 7, 8, 9% market share. That, in that kind of time period, has got to weigh on the proposition of the OTAs. It probably doesn't happen in 2 months or 6 months or even 12 months. But if we fast forward 10 years, a more consolidated industry has got to be bad for them.
And you're underweight. You have a kind of a sell
I wasn't going to
rate
talk too much about my recommendations, but we are. We've kind of, I guess our long-standing thesis has been a bit more long hotels, and their market share opportunity is, we think, longer standing than we think it is for the online travel agents.
I want to ask one audience question from James. Asked about the industry's staffing crisis, what impact on economics, and I think labor, what do you think there?
Well, I mean, there's some interesting snippets of data there. So if you take IHG and you look in the US at their incentive fees, which are tied to the profitability of the hotels, those have fully recovered. Now, not many people would have noticed that number because they don't make that many incentive fees in the US.
Yeah.
But we notice it. It's fully recovered. Hyatt's owned and leased portfolio is more profitable today than it was pre-COVID. Now, this is actually taking advantage of the staffing crisis. Not taking advantage, that's the wrong terminology. But, actually, because pricing's been very good because of this uneven demand, they've been able to charge more without really, but still take some of that service away. Now, does this last? I always think it's a competitive aspect. So every hotel isn't cleaning your room every night, then that's what you come to expect. But as soon as the Sheraton starts doing it, then the Hilton's got to start doing it, the Intercontinental's got to start doing it. So it's going to be that balance around bringing the service back versus the staffing levels. I think probably for the next year, it probably actually helps profitability. Maybe into next year it becomes a bit more of a headwind.
All right, I think we'll end it there, but thank you so much for all of the data that you showed us, Richard. We really appreciate it.
Thank you, everybody. Yes.